Good morning, ladies and gentlemen, and welcome to our JSE Limited 2021 interim results. I have with us our CEO, Leila Fourie, and our CFO, Artie Takadian, and they'll be here with us today to present to you. Over to you, Leila.
Thank you very much, Romy, and good morning, everybody. And welcome. Thank you for attending our results presentation, our interim results presentation. It's my pleasure to join you for our first half, and our agenda is really as follows. I will start with key highlights before delving into specifics relating to our group business performance. And my CFO, Artie Takadian, will then comment more specifically on the financials. I'll come back and wrap up the presentation to provide some comments and outlooks, and we'll take questions after that. Before we get into the detail, I wanted to take a moment just to reflect on recent events. Over the last month, in the midst of what for all of us has been a very devastating third wave of COVID-19 infections, we've also reckoned with a deeply unsettling and very painful outbreak in violence and looting. While the markets have been and still remain resilient, the health and safety of our employees and support for our clients and the operational resilience of our platforms and infrastructure remain a very key focus for the group. And as we recover from this period, it really does remind us that time and time again, South African people, and very much so our markets, have proven their resilience. The JSE has a really important role to play in building and growing the South African economy, and we remain committed to serving the markets as we have done for the past 133 years. Just now focusing specifically on our results, I've started with a couple of key highlights on slide 4, and the results for the first half of 2021 were not unexpected and largely shaped by the high base effect, which we've signaled quite clearly in the same period last year. Capital markets activity was unusually high in March and April of last year due to COVID volatility, as well as the downgrade to sub-investment status and the subsequent exit from the WIGB. Our revenue has now reverted back to more familiar levels, which is expected, and in addition, our financial performance in the period was lower year on year due to lower interest rates, unfavorable currency movements. Lower interest rates impacted our net financed income, an area that is often overlooked, and the stronger rand impacted our USD denominated revenue. And those impacts combined led to an overall revenue decline, which was only partially offset by the higher revenue in the commodity and equity derivatives markets. Now, remember that the comparability of half year 1 2021 with half year 1 2020 is limited by the consolidation of the JSE Investor Services, which is our acquisition of Link from November last year. And this explains most of the OPEX growth year on year. Importantly, including JIS, we delivered OPEX which was stable and limited, that would have limited the impact of the decline in the revenue. So whilst earnings were lower year on year, we managed to sustain high cash conversion, which remains a key facet and feature of the JSE business model, and this allowed the exchange in turn to maintain our liquidity levels. So in this context, I'm pleased with the progress made with the operational and strategic priorities, notably in the inorganic growth space with the acquisition of minority interests at JIS and the Investec Share Plan services. Lastly, with no financial debt, good liquidity, a strong market positioning and robust business activities, the JSE remains a healthy business, and more importantly, it's positioned well for growth going forward. Moving on to slide 5, I'm going to just reflect on our earnings. and this is really how it translated into numbers. So total revenue was down 6% year-on-year, mainly due to the high base effect I've described. Meanwhile, operating expenses increased 6% year-on-year, which resulted in the 19% drop in EBITDA and some margin erosion year-on-year, as the positive operational leverage has been much lower so far this year. Also, adding a negative impact was the lower interest rates on net finance income, and this resulted in earnings per share down 26% year-on-year. However, as you can see, the cash generation has remained very high and even higher than adjusted earnings, which resulted in a conversion rate in excess of 100%. And taking into account our capex and other cash outflows that we'll describe shortly, we still managed to remain liquidity in excess of 2 billion rands. Moving now to slide 6 and covering the factors impacting business performance. If we take a step back, remember that our year-on-year performance was essentially driven by 3 headwinds. First, the most obvious was lower trading activity, with lower trading volumes and value traded across our secondary equity and bond markets. That naturally resulted in lower revenue in the post-trade services, which revenue is largely derived from the equity market. And a stronger local currency to the US dollar also impacted our USD denominated revenue in the information services, as well as other income, one-off from FX cash holdings. And lastly, a material adverse impact came from the lower interest rates, which are now 3.5% versus the 6.5% last year. And this reduced net finance income, which is essentially derived from client cash deposits for clearing purposes. When we look at slide 7, we see this really actually shows the numerous decisions taken by the South African Reserve Bank, the red dots. As you can see, the SARB lowered the interest rate from 6.5% at the start of the year to 3.5% in July, 300 basis points decline in just 6 months, which is unprecedented. And this chart, which represents the all-share index performance since early January 2020, shows that South African equities recovered relatively strongly from a low point in March 2020 when the COVID crisis started. Our headline index ended the year in positive territory, and it's continued its upward trajectory this year. And to date, our headline financials, industrials and resources sectors are all back in the black. Without spending too much time on the slide, which most of you are already aware of, it's important to note that despite the strong recovery in the all-share index, market activity has remained relatively muted year on year. And this is precisely what we're showing in slide 8, which depicts average daily value traded and monthly traded volumes on the equity market over the past 3 years. As you can see from the slide, value traded was down 8% in half year 1 of 2021 versus the prior year, despite the strong recovery in the equity markets that I've just commented on. That was entirely due to lower trading activity, as the chart on the right-hand side shows, a 19% decline in traded volumes linked to lower market volatility. Interestingly, when we compare half year 1 2021 with half year 1 2019, it reveals that both volumes and value traded were approximately 15% higher than in 2019, which explains the 16% increase in revenue in the equity market between half year 1 2021 and half year 1 2019. So this is a really powerful comparison on a more normalized base. Moving on to our strategic and operational priorities. We provide an update on the execution of our operational and strategic priorities, and as you can see, a sizable number of initiatives have been implemented. I'll just highlight a couple of the most noteworthy achievements, and starting with our core capital markets. After introducing a sustainability segment last year, we've seen the listing of our first social bond, and then 6 social bonds for SA Taxi, as well as the first self-labeled sustainability linked bond, all of which confirm the significant interest that this segment is generating. In the meantime, we've launched a pilot for index options market making, while we're also progressing our application for the private placements market with the regulator. And that came after setting up JSE Private Placements, JPP, as a 100% JSE owned company to develop and operate a private placement system technology in collaboration with Globacap in the UK. In post-trade services, now, as expected, JSE Clear has submitted the final license application, and we for an independent clearinghouse. And we also made good progress in expanding our information services offering. Importantly, after signing the agreement with the Shanghai subsidiary, CIIS, it's now operating at full speed, and we're starting to distribute select JSE market data via mainland China. Slide 10 gives you an indication of what's happening in JIS, the previously acquired Link Market Services. As you know, we completed the acquisition of 75% of the business in November of 2020. We completed in half year 1 2021 the acquisition of the remaining minority shareholdings, resulting in sole ownership since June of this year, and this acquisition has been again settled against our cash balances. Meanwhile, we also made further progress in our inorganic strategy with the acquisition of the Investec share plan services and the acquisition came alongside a broader business arrangement between JIS and Investec, which will broaden our addressable market even further. This is very promising news for the business, and similar to a number of other commercial achievements, which we've also mentioned on the slide, namely the launch of the Share Hub and a new collaboration with William Radcliffe, which is a company secretarial and statutory services provider. So you should note, however, that half year 1 period has been financially challenging for the JIS in terms of revenue, because the variable component, which is corporate actions, have fallen short of our expectations, primarily due to lower corporate action activity. Some corporate actions were pushed out, but we are very confident that the healthy business pipeline that we're seeing currently, including numerous growth opportunities mentioned on this slide, will result in sustainable revenue for the business in the future. And we'll speak more to that towards the end of the year. I finally just included a summary of what we're doing in the sustainability space. And I wanted to just give you an update on what we're doing there. The pandemic has accelerated the drive by investors to invest in sustainable companies, and we deeply care about and we promote sustainability both internally and externally. Externally speaking, sustainability has been an important area of focus from the perspective of advocacy. Also ESG investment tools and regulatory frameworks that we provide. In terms of advocacy and engagement, we are part of a number of important international forums, and we've taken a very active role in driving the global standards that are starting to emerge. A number of investment tools that we offer are also ESG focused, And as you can see in the middle of this slide, the best and recent examples of the sustainability segment are naturally part of the social bonds and the ESG focused ETFs that we listed in the first half of this year. More recently, we are very pleased that we've been able to issue a transition bond framework for public consultation, and we're hoping to launch this in the second half of the year. And then finally, our regulatory responsibilities directly contribute to the maintaining of a trusted marketplace for investors and participants. So as such, we are really leading by example in South Africa and globally to make the JSE a leader in a growing and very important dynamic in financial markets. I'm going to very briefly now touch on our group business performance, and moving on to the market activity drivers. We've had 2 more IPOs in the first half than the first of this year than we did last year. And on our cash equity market, volumes were down 19% and value traded was down 8%. But it's important to note that these were highly elevated prior year comparatives, and you'll remember that we were up 15% on the normalized 2019. Bond secondary markets posted lower value traded year on year as well due to lower market activity. And then finally, our equity derivatives value traded was up 10% against a low base last year. And our commodity derivatives contracts were up 4%. There was, however, a sharp drop in our smaller markets, which is the FX and interest rate derivatives revenues due to a stronger rand and lower interest rates in South Africa. Switching now to our business performance on slide 14. I've put a very summarized view of our business performance per segment. And you'll find the usual slides discussing trends in the back of the pack. So in terms of primary markets, we posted a stable revenue despite much of the new sustainability linked products in the listing of social bonds. And as I've said, the ESG focused ETFs. Meanwhile, we had a higher number of IPOs and a sharp increase in bond listings with 317 new bonds for a nominal value of 3.8 trillion rands, the latter being up 15% year on year. Those positives were offset by 15 company delistings on the primary equity market, slightly higher than the 13 in the prior year. But the market capitalization of all listed instruments on the JSE increased by 5% from the year's close to 30 June and by 11% if we compare half year 1 to this year to half year 1 last year. Then secondary markets, that is equity and interest rates, were down mid-single digits due to a highly comparable base last year. And as I've just said, the sharp decline in volumes and value traded. On the derivatives front, revenue from FX and the interest rate derivatives was down due to lower volumes and lower hedging activity overall. And more positively, with greater value traded on the equity index futures, revenue for the equity index derivatives was up 3% higher year on year. And then lastly, revenue in the commodity derivatives market grew 13%, underpinned by volatile market trends and linked also to dry weather conditions in parts of the world. Volumes were up 4%, and as I've just said, while the value traded grew 28%, it was in anticipation of inflation. Now, post-trade services largely reflects lower activity in the equity market. As such, the clearing and settlement revenue was down 14% on lower volumes and values. And our information services revenue was 6% down. So I'm going to leave the floor now to my colleague and my CFO, Artie, and she will take us through the financials.
Thank you, Leila, and good morning to everyone. These results are really aligned to the trading statement issued in June.
Artie, are you muted? I'm not sure if everyone else can hear you.
I'm unmuted.
We can hear Leila.
Can you hear it fine? Good.
Yes.
Great. As I was saying, the financial results are aligned to the trading statement that we issued in June, and really they set the stage for what is reflective, as Leila mentioned, of the tough external headwinds, as well as the base effect of March-April record high trading values last year, that making growth from which is really hard to achieve in the current state, where we continue to experience the scourge that is COVID-19. That said, we continue to have enviably strong margin in percentage terms on the back of a very diversified revenue suite that in challenging years like this translates into resilient financial performance. So starting with our trading and profitability, operating revenue that is generated by the segments was down 3% year-on-year, as Leila has unpacked. The total revenue drop was higher at -6%, and that is because it's dragged down by the other income, which includes a 43 million decline, mainly due to forex gains realized last year. So where we sold USD last year. The operating expenses are up 6% year-on-year, primarily driven by, as we mentioned, the JIS integration for the first time. And of course, I'll unpack that shortly. More importantly, we managed to keep the rest of the group's cost base broadly stable year-on-year. The 19% decline in EBITDA follows this, as well as related margin dilution, as the EBIT margin dropped 31% in half one. JIS had a dilutive impact on our margin in percentage terms due to some of that revenue underperformance that Leila mentioned due to the lull in the corporate actions activity. And so some underperformance on the group margins following that negative operating leverage impact. Moving on to earnings after tax, that was down 28%, reflecting the lower operational profits at 35% decline in the net finance income year-on-year. And you'll have a look at that in absolute terms shortly. If we move on to a cash and capital lens, we continue to be really strong in cash and capital terms. This is an inherent feature and strength of the JSE's operating model. Cash from operations was naturally down 10%, but we continue to sustain cash conversions of adjusted earnings at over 100%, 105%. Although adjusted earnings were of course lower, 20% year-on-year. In total, we spent or cash outflowed just over 200 million in investing in the growth of the business. Much of that spend is long-term investment for growth, and that was unpacked in the financial statements. You'll see 75 million for the remaining stake in the JIS business, and an amount for the investment in GlobalCap, plus the CapEx that is mentioned on this slide. So we managed a slow and steady CapEx spend of 46 million in half one, and all in all, our cash balance declined slightly, as it does in a half one cycle, to 2.1 billion rand. And as I said, it's perfectly normal for a half one cycle because we pay dividends, and we'll unpack that shortly. If I move on to an income statement view in absolute terms, just some more comments on our performance by looking at the accounting view. Firstly, you can see the negative impact from the other income, which is largely driven by that USD ZAR exchange rates that we sold and gained and realized the gains on last year. The point I made on strong margins you can see EBITDA margin of 42%, EBIT margin of 31%, and after-tax earnings margin 28%. Still really strong given the challenging environment that we operate in. We also operate in an extremely low yield environment, as Leila mentioned, and this is a global phenomenon. A call out on the net finance income, which we are working within the constraints we have in terms of regulatory capital requirements for ring-fencing cash, as well as working capital requirements to optimize this. All of this ended up at that decline in after-tax earnings of 9 points. If we move on to a closer look on OPEX in the next slide, the reported increase in total operating expenses was 6%. But if we strip out the JIS, the rest of the group cost base was broadly stable at 803 million rand. Before I move on to unpacking that, I just want to comment on JIS cost profile. So they've added about 50 million of operating expenses and about the same in revenue, meaning that the business was much less profitable than the margin percentage, in margin percentage terms, as you saw on the previous slide. And of course that weighed on our EBITDA and EBIT margins in percentage terms. But going forward, we're really quite positive and looking forward to the accretion in profit terms from this business. And the integration is going well, as Leila commented on the slide. On the cost profile, it is largely a people's business. So about 36% of the cost base relates to personnel expenses and general expenses, which is predominantly administrative type expenses, and to a lesser extent, about 14% of their cost profile relates to technology costs. If I unpack the rest of the group's largely fixed cost base, our revenue and our personnel expenses, our personnel expenses was driven largely by annual increases in gross remuneration. And of course, the headcount is a large driving force for that cost base, that cost element. So you will see that our exit headcount at H1 was 417. I think this is a record high for our actual headcount exit, still against the planned, still under the planned full headcount complement, but it is also a pandemic related phenomena to have really quite high headcount levels and low attrition rates. There is some base effect in the personnel expenses. If I just move on to the technology costs, there was included in the technology cost is of course spend on cyber security and the rest of the fixed cost base, which increases by inflation. But we also wanted to call out 12 million rand one-off spend due to the mainframe migration costs. The depreciation and amortization, we understand that number well, we've guided well, and it is well within our expectation. On general expenses, just a comment that that was down 26 million year on year, and last year included some unusually high non-recurring expenses that were linked to COVID. This was partially offset by timing differences at the Jeff Trust consolidation level. So this is a first-time consolidation for Jeff Trust, and we see 11 million rand in H1 worth of bursary payments that is categorized as general expenses. If I move on to the quality of our earnings, which in the next slide remains incredibly strong. As I said, we sustained a high level of cash conversion against our adjusted earnings. Although the adjusted earnings were down, the cash conversion would of course follow that, and the decline in operating cash generated was more limited due to non-cash items being stripped out, so it was more limited to 10%. More importantly, we were able to increase cash conversions to 105% above last year, and certainly above our long-term average of the past. which is closer to 90% conversion. Now, if we move to the CapEx on slide 20, as I mentioned, it was stable at 46 million to reinvest in the existing business, but importantly to point out, we spent over 200 million in total that left the group in the form of long-term investments, that is to support the JIS minority buyout as well as the GlobalCap long-term investment. I've unpacked the 46 million, and that is a balance between growth initiatives within the existing base, to call out more mainly driven by the co-location spend, some rejuvenation on IT infrastructure to keep and sustain that revenue base, and we've guided on an indicative spend for the rest of the year at between 100 and 120 million in CapEx. If we move on to where we've landed in cash terms, so as I mentioned, we're really strong on the balance sheet. We continue to have a clean, unleveraged balance sheet, and started the year at just under 2.5 billion of cash, and generated that 105% cash. But we also managed to invest in the GlobalCap business, so that is reflected on this slide under investing activities, and the financing activities captures the minority buyout for JIS's remaining portion. It also reflects the dividends that we paid in this half, and so to land on a over 2 billion or just under 2.1 billion cash base is really a great performance, and we're quite pleased on our balance sheet and the strength of our balance sheet, setting us in which lands us as very well poised for growth going forward. So I think, Leila, that brings us to the last slide anyway, and the points that I wanted to cover in terms of our financial performance. And I'll hand back to you. I look forward to the one-on-one engagements.
Thank you, Artie. Thanks very much. And I'm going to wrap up just briefly, really to remind you of our strategy and our priorities going forward. These remain intact. So I have already described our long-term strategic framework during our full year 2020 presentation in February this year. And we really have three key priorities in the top blue section of the slide. We have a high dependency on equity market revenues, and we want to grow an annuity and diversified revenue stream. Secondly, investing in IT infrastructure, which is robust, is critical to maintaining strong operational resilience against a number of threats, including cyber threats. And this is consistent with our objective of running safe and trusted marketplaces. We are also focused on the national agenda and how we can contribute to making South Africa an attractive investment destination while further embedding sustainability within our business, as I described earlier today. In the near term, our focus for the rest of 2021 will be on three different aspects. First, we will continue to drive our inorganic growth strategy and integrate the JIS. That means growing the business by converting the commercial pipeline that I've mentioned earlier today. Secondly, following the investment in GlobalCap, we have started developing a private marketplace platform in South Africa, and we will focus on progressing this. In our core business, we will continue delivering new products and services in the capital markets and information services space, as well as post-trade. And in Asia, we will focus on expanding our distribution to the CIIS with other distributors to reach new markets. In information services, whilst we've launched the phase 1 of the Trade Analytics platform and Market Data Connect platform, we'll focus on delivering those platforms for our clients as soon as possible. And lastly, whilst we've submitted JSE Clear's independent clearinghouse application in half year 1, we will collaborate with the regulator to focus on that application, and we hope for a successful completion as soon as possible. Moving on to slide 24, I've just covered some key considerations for our business. I think we've jumped, yeah, that's it. Thanks, Romy. Key considerations for the remainder of 2021. I'm not going to go into a huge amount of detail, but really our global market environment will be largely influenced by the success of the global vaccine rollout. ESG remains a fast-growing influencer, and our local political, social and economic environment remains extremely sensitive, particularly in the aftermath of the recent unrest. Lastly, in that context, we note consensus expectations are for a series of small incremental increases in the repo rate from Q4 21, and strong commodity prices continue to support rand strength. Now, moving on to slide 25, I just wanted to wrap up some of the key takeaways of the interim results presentation. And in summary, the first half of 2020 reflects the impact of a higher base effect and a remarkably changed interest rate and foreign exchange environment. And despite this, the business has continued to generate stable cash levels, which is a unique and distinctive feature of our business model, particularly during a period of downturn such as what we're experiencing now. Operationally, the business is well supported and flexible with robust and modern technology underpinned by very effective regulation. Financially, our strong balance sheet and unencumbered, which is unencumbered by debt, allows us to explore growth opportunities, and we continue to ensure adequate levels of regulatory capital, and we are more than well capitalized, and this allows us to increase our ordinary dividend payout ratio over a period of time. Our focus in the second half remains on delivering long-term sustainable value. We will continue to invest in core business resilience, and we'll also continue to focus on growth initiatives, both organic and inorganic. And I think with that, this brings us to the end of our sort of formal presentation, and we would like to now open the floor to questions. Romy will read those out for us. We'd ask you to pop those into the chat box, please, or unmute.
Hi, Leila. At this stage, there isn't anything in the chat box. Matthew, is there anyone with their hands up that want to chat?
Chris Logan has his hand up.
Yes. Thanks very much, Leila, for the presentation. I realize you're dealing with a very tough South African environment, but you know, when I look at the JSE, you've been going backwards now for over 5 years continuously. And I'll just give you some color. Your returns topped out in 2015, your return on equity. You've had net delistings every year since 2016. Your share price is the only listed exchange I know that's down over the last 5 years. You're the worst rated exchange. I mean, you're now on a 7% dividend yield. That's a tobacco stock rating. The strongest metric in your income statement is actually your average cost per employee, which is now 1.5 million rand per employee. So, you know, isn't a more robust approach needed to turn this business around with a greater sense of urgency? Because, you know, and you've dramatically underperformed the JSE All Share Index, which you compare yourself to. So on every metric, there's a cause for concern. And it doesn't look like it's appreciated within the organization. You can't say you've got good quality of earnings when they keep going south and when you're so poorly rated. I know this is harsh, but how do you respond? You know, I think I agree with you. The JSE has a key role to play in building South Africa, and you do that by bringing new companies to market and by promoting good governance, but it's not happening.
So, Chris, thank you for that. And I think that we need to acknowledge that over the past 5 years, there has been a negative jaws, and our revenues have not grown in line with the market sufficiently. And what I would point to, there are two dynamics at play here. The first is our pricing reductions. Now, those pricing reductions translated into 99.2% market share retention against the competitor. Were those were the competitor to have, like in most other countries, grown to 15 to 20% of market share, that would have had a very different impact. Those pricing reductions, we are now more or less in line. The second factor of stress to the financial position, and it would be disingenuous for us not to acknowledge that, is the high amortization as a result of the ITAC project. Now, this is a confluence of two events which have created a drag on the growth potential, but with respect, I would have a different view on the actual returns of the business, a business that is generating consistently 18 to 19% ROE. When you compare that to the cost of capital and to many of the other financial companies, I would argue strongly that while we certainly do need a transformational growth strategy, our actual returns, our cash generation, our dividend yield are all very positive. Now, we cannot divorce the exchange from the economy in which it's grounded. Neighborhood does matter. And notwithstanding the fact that the real economy has contracted severely and the real economy has faced incredible headwinds, the JSE has continued to grow its dividend by 7%, well, to give a 7% dividend yield. So I think we as South Africans are congenitally negative. And I don't think that, I think that our financial markets are deep and liquid. The financial markets have continued to grow, notwithstanding the fact that there have been delistings, and I acknowledge that. If we compare ourselves to the London Stock Exchange, and I'm using World Federation of Exchanges stats, the London Stock Exchange has contracted over the past 10 years its number of listings by 21%, and the JSE has contracted by 17%. So there is a global phenomenon, and of course it would be one could point to or identify a number of hot growth spots like pharma or technology. The reality is that our neighborhood does matter, and South Africa is not the pharma capital, and we have, aside from Naspers and Prosus, a potential to grow technology, but that's a macroeconomic factor. So I do take your point, and thank you for your comments, your very strong comments. We do have a growth initiative. We do have a transformational mindset. We've spent 200 million Rand this year on growth initiatives, and those are aimed at diversifying the company. It's obviously transforming and turning around the financial position is something that needs to be done with a steady and quite mindful hand, with consideration of the context in which we're operating. With regard to our financial position going forward, as I said, our pricing is now largely in line with our competitor, and our amortization has peaked, and that will start to drop off from next year. Any more questions?
Kiama's got his hand up.
Yes.
Kiama?
Hi, Leila. Hi, Leila. Hi, Artie. Thank you very much for the presentation. So I just have two questions from my side. The first one is just related to JIS costs. So mainly, what proportion is normalized versus non-recurring related to sort of the first-time integration? And should we possibly be expecting margins to be more in line with group in 2H, given the non-recurring nature of some of the costs in this business? And secondly, you had previously mentioned at the full year that there's 145 million rand 2021 capex envelope that you had envisioned. So is this still on track for 2H, or are you going to revise guidance for this? Thanks.
Shall I just go for it? Thanks very much, Kiama. So just on the first-time integration on JIS, there's very little. I mean, it's negligible, the cost that's associated with one-off consolidation for the first time. So you can take that as their cost base. Of course, there's a smaller element of their cost base that expands as their corporate actions expand, and they need to build out more people when that happens. So there is a variable portion to their cost base, but in the main, you can take that as reflective of what they need to support the revenue in the business. And then your second question regarding the guidance of 145 million. Yes, COVID has certainly slowed down and put the pause button on a number of our initiatives that we would have ordinarily liked to have spent in this year in CapEx. So, and there's logistical issues, there's resourcing issues, and there's time constraints as well associated that feed into that CapEx being lower this year. So we've given the guidance of 100 to 120 million purely because those moving parts are also very difficult to call. Direction of travel, you should take away that it is definitely not in the 145 million space as we guided previously. We are just adjusting the guidance as up to 120 million.
Thanks, Artie.
Thank you very much, Artie.
Thanks, Kiama. Any other questions, Romy?
Hello, there's a question here from Louis Kruger. He said, can you please remind me of the total you paid for JIS? Is there an opportunity to cut costs? And what improves the performance of this business? That's the first question.
So the total was 225 million for the 75%, just under 75%. We recently acquired the remaining just over 25% for just shy of 75 million. So with acquisitions, I'm always very skeptical about the concept of cutting costs, because I've seen so many acquisitions being made with the promise of cost cutting as the basis for the business case. Certainly, we are prudent on costs. The approach that we are taking to generate returns in this business is to modernize technology and to scale the business up. You will remember that the business represents between 20 and 25% market share. And so the opportunity to expand and grow is material. We have had a number of top 40 customers signaling to us that they've given notice and will be shifting their business in the second half of the year. And we will announce those as soon as those are final. Those will make a material difference to the revenue, both annuity and corporate action alike. We also have a number of quite transformational initiatives that are underway. The Share Hub, which is a digitized mechanism to interact with customers, has signed up 40,000 new users in the last few months. And we are also looking to introduce a number of ancillary services. The Investec Share Plan business client base is not mirrored by the JIS client base, which gives us an opportunity to market and open and expand that business. So we are hopeful, and we do have a very strong and promising pipeline, and we expect that it will take us, I'd say, a year to 2 years to start to demonstrate that growth. So it won't necessarily be reflective immediately. We certainly expect that we'll have some growth with a number of prominent corporate actions coming up that we'll be processing. However, the real growth requires there are notice periods that are required, particularly of large companies, in order for them to switch, and some of those are busy working through notice periods, and others are in the signaling stage. So we are really taking a growth lens to this. Of course, we have and continue to manage our costs very conservatively, but for us this is about growing that market share from 20 to 25% upwards.
Leila, we've got another question here from Jacques Hasbrook. He says, given the cash position, at what stage do you start doing more aggressive share buybacks?
Archie?
A share buyback would make sense if we feel as though we can't employ that capital to deliver better returns to shareholders. At this stage, we have other things that we would like to do that would inspire growth for the rest of the group with that cash. And when we do the maths, whatever cash is remaining is not worth embarking on an expensive corporate action like and I don't mean just in financial terms, it's also resource-wise, like a share buyback. So we believe that we've got better use and value to place that cash in rather than to do a small share buyback action. If I could just comment on the costs, because if we've got a minute, I just neglected to point out a couple of things that I would have liked to on the costs slide, because I had my puppies competing for the camera at the time. I did forget to mention that as many of you know, our cost base grows by inflation each year, and largely it is flat because last year, half one, we saw some one-off costs that have disappeared in this half, and therefore, the inflation increases would have captured that space. So I just wanted to make that point on the costs, and also for you to take away that we continue to keep a really, really heavy focus on cost control and cost management. In terms of the non-cash items, we've given guidance of what that depreciation profile is going forward, and it's at the back of the slide deck as well, and that will just unwind as it does over the years.
Thanks, Archie.
Leila, just to give you a heads up, Chris says he would like to ask 2 more questions. We've got 2 more minutes to go, so we'll just have to be as quick as possible, if you don't mind, Chris. Thank you.
Yes, thanks. And I must just pick up, Leila, I mean, you said you compared London, their delistings over the last 10 years. So, that's a long way back. Over the last 6 months, they just have had record RPOs, 49 RPOs in the last 6 months. And they take it seriously there. There was a high-level study done as to what would make the exchange more attractive, which reported to Treasury. Because they realize IPOs fund growth companies, which fund new employment, which fund technology. We see nothing of this nature happening here, and we keep going backwards as a nation. So, you know,
okay, and your second question, Chris?
Yes, my second question then is, you talked about your high dividend yield. That's hardly a good sign. That's that sign that the market thinks you ex-growth. You're on the same dividend yield as a tobacco stock. And thirdly, your returns, your ROEs dropped continuously from 30% in 2015. So that's how come you rated like a tobacco stock. Yes, you generate a lot of cash. So do tobacco stocks.
So Chris, I would suggest that perhaps the London Stock Exchange is in a very different market right now. And in fact, we had a government official contacting us last week to request a meeting to discuss our approach to regulation, because they had been recommended to engage with us. They have made quite substantial changes to their regulations. We recently issued a cutting red tape paper. Insofar as our relative rating and what industries you might want to compare us to, I do come back to the same point, and that is there is a country dynamic and a macroeconomic effect at play here. In fact, South African companies, according to Bloomberg, are undervalued by between 30 and 50%, depending on whether you compare them to emerging markets or the world. And so the JSE is no different. So South African stocks, generally speaking, are undervalued. And that is, I'd say, a function of both the point in the cycle as well as country dynamics. So with that, thank you for all of your questions, and thank you for your comments, everybody. We really do look forward to chatting to you one-on-one, and Romy would be available to take any other questions that you might have. And we would be very happy to discuss those either over email or in a one-on-one discussion. Thank you very much for joining the conference, and we look forward to engaging.
Thank you. Bye.